My next guests say that short-term rates are down now with Fed easing, but that long-term rates may continue to go up. For those who think inflation could be a little bit sticky. For more on how to position against that, let's bring in Komal Sri-Kumar. He's president of Sri-Kumar Global Strategies. And Max Wasserman is senior portfolio manager at Miramar Capital. Sri, you've been warning about this for months now. Why is this taking place? And what does it mean?
The Fed mismanaged the interest rate cut on September 18th, Kelly. You have heard me say that before. My suggestion then was there'd be no rate cut at all in September. Instead, there was a jumbo rate cut. So the Fed believes that when they cut the short-term rates, the long-term yields will also come down. But the basic truth in economic theory is that the Fed controls only the short-term rate and the long-term rate is determined by the market, number one. Second, if you are in equities and inflation picks up again, you have protection in the form of your equity price going up and giving you some form of a safe haven. But if you are in bonds, you do not have a safe haven because when inflation goes up, the interest rate doesn't increase on the bond you're holding. So bonds are much more sensitive to inflation and they are reacting to higher inflation expectations. One other warning. Neither presidential candidate is talking about how to cut the fiscal deficit, how they are going to deal with the debt in the new year after January 20th. And unless the new president does something about it very quickly, I am looking for the 10-year to head toward 5%. So in other words, the increase that you have had so far is not sufficient. More Fed mismanagement in the form of more rate cuts in November and December, as Steve referred to, will only hasten the increase in long-term yields, Kelly.
Okay. I'm looking, you mentioned that inflation, and yes, politics may be a big part of that. We'll have more on that in a bit. But the inflation expectations are up if we show the 5-year break-evens. That's the near term, not the forwards. They were at, and Steve, I'd like you to weigh in on this. We were at under 2. Now we're at 2.25. That's a decent move in the past couple of weeks.
I think it is for sure. I just not sure that further Fed rate cuts will bring down, will cause yields to rise. I really think it's the inflation outlook and the outlook from Fed officials that will ultimately tell us where we're going to go. The market also has a belief, Kelly, that growth is inflationary. I don't believe that to be the case. I think what we've seen strong growth and strong job growth without the inflation. So we'll see. I think that stubborn inflation report was part of the problem. I think also a bit of a hangover among Fed officials having done the 50 that they may want to pause so the market's a little more circumspect about the outlook for rates.
Shri, normally we debate the theory of this, but can you be very pragmatic about this for a moment? I mean, we've heard high-profile folks like Druckenmiller say they're shorting bonds. Today, Joe Livornia was saying maybe the 2-year is going to sell off quite a bit more and go up. I mean, what is the practical advice for investors, even if it just relates to, look, the stock market, other than the Russells and maybe other than, it's largely taken this in stride and shrugging it off?
The way you're going to react to it is first, if you are, to the extent you are in fixed income, you want to reduce the duration of the holdings rather than hold 10-year, 30-year paper or long-term corporate paper, come shorter term. They are going to lose less money when the yields go up. That is one thing you would do. Second, find yourself some alternatives to bonds and the current setup. In addition to equities, you are looking at gold. And I've been looking for gold as the ultimate currency, Kelly. And you referred to it earlier on in the program that even though the dollar has strengthened against the euro, think about the gold price as if gold is a currency and dollar exchange rate is given by the gold price. And that is shooting up, which is essentially telling you that there is a flight from currency. The market is leaving the dollar, it is leaving the euro and seeking gold as a safe haven. It's going to be more of it. We are now at about 27.30, 27.50. I would see it hitting 3,000 before year end. And more policy mismanagement, we'll be looking for even higher yields.
So you see gold going high. Let me just, Sri, circle back in a second, bring Max in here as well. Max, Sri sees gold going higher, is warning to stay out of bonds. I would add to that, you could argue sometimes that nominal stock market gains are the flip side of dollar debasement, for lack of a better word. And I don't want to go totally down that rabbit hole, but, are these less exciting than if they were real? In other words, if they were happening against the context of a currency that, that was more stable?
Well, thank you for having me on. It's good to see you again. But yes, we've been Fed watchers as well as everyone else in your panel, and we think the Fed is continuously making mistakes. I mean, the anticipation that they want to cut it, bring the Fed funds rate down to a neutral rate, bring it down to, let's say, whatever they call inflation under 3, it's going to have a material effect. So we're not so positive on bonds either. We've shortened our duration. We like 1 to 2 years. Treasuries, we still think they're a good place to be, but we would not be going longer. But the Fed has said, based on their 50 basis points cut, that they want to bring it down to a neutral rate, which implies 180. So if they're going to do it, we think it's more of like 12 to 18 months out. We think it's a mistake to accelerate it. We think they should have done 25 and done it slower. But the data that's coming in is showing that the economy is a little bit stronger than anticipated. Retail sales were a little bit stronger. Employment's a little bit stronger. GDP's a little bit stronger. And they're talking about major interest rate cuts. And I just think it's a huge mistake. And I think it will be inflationary on the 10-year because neither candidate or anybody is talking about deficit reduction. In fact, everybody's talking about spending more money. So we see the 10-year going higher.
I'm not sure.